There's one key reason why more people are buying annuities right now, and the simple answer is interest rates have gone up a massive amount in the last 12 months. We lived through a period of over 15 years where interest rates were virtually zero, and in the last 12 months interest rates are flying up. As a result of this, an annuity as a retirement income option is 63% better than what it was 3 years ago. If you look at this chart now, you can see that a male aged 60 with £100,000 of pension fund back in July 2020 would have got roughly £4,000 a year for a £100,000 pension fund. That would have meant 25 years income payments would have been needed to give him his £100,000 back. However, if you fast forward to the 17th of August 2023, annuity rates are linked to interest rates, life expectancy, health, location, all sorts of factors. Interest rates being the main one that's boosted these, you will now get £6,351 a year for the same £100,000 of pension fund. The other major change for annuities that's come in the last 10 years is the inclusion of a 30-year guarantee period. So what does that mean for most clients and individuals? Well, back in the olden days, shall we say, when personal pensions were invented in 1990, the average guarantee period that was taken would have been either 0 or 5 years. Later, a 10-year guarantee period was included. But most people who you might have spoken to who said, I had a pension, or my father had a pension, my mother had a pension, a relative had a pension, someone I know had a pension, and that pension died with them, it would have been because the guarantee period had expired. A guaranteed period works when you set an annuity up, it is guaranteed to be paid even if you pass away up until the end of the guarantee period. Well, now you can have 30-year guarantee periods, and that means that anyone who sets up an annuity in 2023 has got the peace of mind that if they were to pass away tomorrow, next year, 10 years time, the remaining balance of that 30-year guarantee period, the annuity will be paid in full to the nominated beneficiary. So right now, we're recommending annuities to people in 2023 who have the safe peace of mind that if they died at any point in the future, that annuity will at least be paid until 2053. Obviously, if that person lives another 40, 50 years, the annuity would be paid forever, because an annuity, the textbook definition of an annuity, is a guaranteed payment for the rest of your life. The guarantee period obviously applies on death. So this figure quoted on the screen here is £6,351. That is for a male age 60 with £100,000 of pension fund who has a 5-year guarantee included. If you were to include a 10-year guarantee, the starting income drops to £6,306. If you were to include a 20-year guarantee, the starting income falls to £6,133. So a lot of people are interested in taking out the guarantee period of 30 years. It ensures that if that person passes away at any point after the annuity set up, that income payment will at least be paid until the end of the 30-year guarantee period. So for a male age 60 with £100,000 in this example here, who hands over his funds to an annuity provider, he will get £5,898 guaranteed for the rest of his life. As I say, if he passes away, his family gets it for the remainder guarantee period. It means a minimum of £176,000 will be paid back to his estate, his family, if he were to pass away over that 30-year period. That has never been available before in annuities, and we feel it is a very important driver. Annuity rates have gone up, as I say, over 63% over the last 3 years. Couple that up with a brilliant guarantee that's in force, and more people are interested in these product options. The one area which we have to draw your attention to where annuities at a level in payment can have problems in the future is if you were to have really, really high inflation for years in the future. If you've taken out a level annuity which might pay you, say, £6,000 a year for £100,000 going in, and the rate of inflation was 7% a year for the next decade or so, then the value of that £6,000 a year annuity would reduce and diminish over time. However, why we don't think that is such a huge risk right now is what we can see is the government tackled with a big inflation problem last year. For the first time in 30 years, we had a real high inflation problem. The main target of all central banks all over the world is to bring inflation back to its 2% long-term target. The UK government is going to carry on raising interest rates until it gets to this 2% target. It has already said that, and as we said, annuities are linked to interest rates, so we believe that annuity rates are really high at the moment and they could get higher in the coming weeks. So now really is the time to speak with an advisor about what your options are on how you take your money from your pension. Impaired life annuities, also called enhanced annuities, is where an annuity provider will assess someone's personal health and lifestyle situation to find out whether they can offer an enhanced annuity that will pay a higher level of income. So if somebody has a pre-existing medical condition, maybe in the past had cancer, heart attack, stroke, those sorts of things, or is diabetic or can be a heavy smoker, then the annuity provider will pay a higher level of income. So as you can see from the chart on the screen, for a male aged 65 with £100,000 of pension fund, who has no health conditions, he might get £7,287 a year. And as you can see from the other coloured bars, a smoker would get £8,000 a year, just over £8,000 a year. Someone who's diabetic might get £7,967 a year. And someone who's had a stroke in the past would get £8,853 a year. As I say, we would have to assess from a best advice point of view what would be the best option for you, whether purchasing an annuity would make sense. And let's not forget, you don't have to use your entire pension fund to buy the annuity. You could use part of your pension fund and or do a dripped or a phased annuity purchase over a number of years. What we're showing you here is annuities are much better value than where they were 3 years ago. As I say, in the last 12-18 months, the government, the UK Bank of England, has risen interest rates 12 times. There's an anticipation that they're going to go up again in September. So these rates being high could go higher again. Annuity providers are changing rates very regularly, maybe monthly, quarterly. I mean, obviously, if there's an interest rate rise, they will change rates at that point. However, before the last rate rise, there was an anticipation that rates were 100% going to go by 0.25%. The annuity rate actually rose a week or two beforehand. Anyone who gets an annuity illustration has the peace of mind that that annuity illustration is valid for 30 days. So if rates were to come down during that 30-day period, the rate quoted on the illustration is valid. Also, if rates were to go up during that period, you can cancel one quote and get a new one. So now is the time to be talking about annuities. Do they work for you? Could they fit as part of your overall retirement income strategy? And as I say, a wealth of advice. Our experts in these areas, pension income, pension retirement options is what we do most. No nonsense financial advice. You will walk away with the financial options report, understanding exactly what it is you can do with your pension fund when you hit that age when you want to retire. So thanks for watching. For the wealth of advice, little update there about annuities, how they're working in the current market, why we think they might be a good thing and why you should consider them.